So I'm going to thank you for joining us
Shannon
today. What we're
Bedsole.
going to talk about is maximizing tax savings for childcare facilities, and this is probably something that
Join the meeting.
most childcare facilities have not heard about yet, because they're so focused on taking care of their charges, right? Of the kids, and so they don't know about this, and that's one of the things we want to bring awareness so that people can understand how they can benefit from it. So the things we're going to cover today is really what is cost segregation and accelerated depreciation, because a lot of people don't know about it. And we're going to talk about how bonus depreciation is really defined and how that can actually be used to your benefit. And then we'll show an example of some of the cash flow increases that are available and things that we've done on similar properties. And then Dan's going to cover the benefits to owners of childcare centers and how this can benefit them specifically, because they do have some unique physical characteristics, separate from other types of commercial buildings. And then we'll talk about making up for missed opportunities. So this is something that people think that once they bought a property and it's a year or two past, they can't take advantage of it, and that's not the case. So we want to show you how that's going to actually work. So let's talk about a little bit about us. Dan, I'll let you talk about yourself a little bit there.
Sure. So my background is actually in education. I worked in nonprofit private schooling and loved it. And after about 10 years in that, I said, this was fun, but it's time to move on to something else. And so I ended up with CSSI. My initial goal was to be a superintendent, and I found out from my professors that superintendents have an average shelf life of 2 years, and then the school boards run them out of town, and then they go into sales and consulting. And I thought, why don't I skip that stressful 2 years while I still have my hair and just go into sales and consulting? And I'm glad I did. I love it, especially because I really enjoy working with small business owners and helping them realize some of the tax benefits that often people think of as only available to, the people who own $1 billion worth of real estate. But they can be really transformative for people. So I love what I do. I love working with Tom and getting to work with people who own real estate and are living the American dream.
Awesome. Now, I've come from a little bit similar story that I started off doing something else. I worked for Shell for 27 years, and then took early retirement from them and worked in the scuba diving industry of all places. And then found CSSI and realized that kind of like Dan, that this will be, don't know what happened there, but I think this will be beneficial to you because we're going to show you how this is going to really apply to your business and how you're working. So basically, cost segregation looks at buildings differently, right? You've got two different categories of commercial buildings: the 39-year assets, which are, retail buildings like stores, offices, hotels. Airbnbs are actually in this 39-year category also. And then you have the 27 and a half year. This is the residential buildings, whether it's a single family home that's a rent house or multifamily apartment buildings. These are the two asset lives of commercial buildings. And so what usually happens with CPAs is they take, okay, this is your building value. They put it in a single bucket. We always like to talk about buckets in this case. Put it in a bucket, say it's $1 million building, and say, okay, we're going to divide it by the economic life, whether it's 39 years or 27 and a half years. And that's what is the depreciation number. What we do in cost segregation is that there's actually other buckets of costs. And so we're going to break it down. This is the real economic life of a building. You've got your building structure, things that are tangible personal property. That's a 5 or 7 year asset. And then things that are, for like in office buildings, is called qualified improvement property. This is leasehold improvements where people are leasing space and they're building out things, but they're not making change to the actual building itself. And then land improvements. Now, here's a category of some of the way these things break down. The land improvement is important, especially in this situation for childcare, because they have so much of a parking lot or a big concrete footprint around their building just to be able to have traffic navigate safely. So that's a big piece of their expenses that they really haven't been able to break out and identify. We're going to be able to do that in the study. Now, once you've got the study performed and all of these things broken out into their different economic lives, we can apply some of the interesting tax law benefits. And the first one is bonus depreciation. So bonus depreciation says anything less than a 20-year asset life, you can write off sooner according to the tax law for, and in this case, bonus depreciation, when it was really introduced in late 2017, the initial rate was 100%. And so you could take everything in these green box and write it off 100% of its value at the time you did the study. And that's a great benefit. We'll talk about that in a little more detail. But let's kind of show an example of what this looks like in a real world example. This is for a daycare center in the kind of in the Houston area. One-story building, 10,000 square feet. Building costs $5.4 million. This was going to be scheduled to be purchased in December, and we're doing the study on that. They looked at that and they said, okay, doing straight line depreciation, it would have been $5,700. Did the study, broke it out, and say, okay, we think a building structure is going to be still a big piece of that, which is 3.9 million. But you've got your tangible personal property and the land improvements, the huge parking lot and pavement are big components in and of themselves. With 100% bonus, which got brought back on the one beautiful bill, you can take all of that in the first year, right? So you got a $1.4 million depreciation deduction versus the less than $6,000 the old way. So that's a huge benefit to cash flow because that means that's going to reduce your net income, your recordable net income, and that reduces your taxable liability accordingly. So when you're talking about accelerated depreciation, this is kind of how this looks as far as you've got the 5-year property, then the remainder 15-year property, and then the balance goes out over 39 years. So if you look at this stair step level, this is without bonus, but you're breaking it up into the different asset categories. So you've got the first step, which is the 5-year asset, which has 5-year assets plus the 15-year assets, the first 5 years of the 15, plus the first 5 years of the 39-year asset. It all gets added up. The green numbers that you see here are just initially just the 5-year piece, and then just additionally the 15-year piece. So you can see that that's a benefit because you're recording those expenses sooner, but it's still not as big a benefit as bonus. So let's take a look at the same structure and compare the bonus chart. This is the same chart. You just see there's so much of it recorded sooner. That's a huge benefit. So you've got all of the 5-year, all of the 15-year, and 1 year of the 39-year recorded in the first year. So you can see that's a dramatic benefit, and it's going to be a huge improvement to the owner's cash flow. This is an example of what happens with 100% bonus after a couple of years of ownership. People may say, well, I can't do that. Yes, you can. And we'll talk about that in a little bit more detail. But you see the huge spike having that big 100% bonus effective even a couple of years, in this case, on the 4th year after ownership, you can still do that. Now, the straight line and the remainder of the write-off and under accelerated are pretty similar. Straight line's going to be a little bit greater because compared to accelerated because you've written so much of it off earlier. But that difference is not it's not a huge difference. And the biggest benefit is that the time value of money, you've got the expense write-off sooner in the life cycle of the building rather than waiting until later. Okay, I'll turn it over to Dan to tell us some of the benefits to childcare centers.
Sure, sounds good. It looks like we may have had one more person join us. I think that's Jorge. Welcome, Jorge. Quick recap for you, Jorge, and anybody else, if it would be helpful. So we're talking about how you could accelerate depreciation on your building. What does that mean? It means you are going to be able to write off the value of your building sooner. So why would you want to do that? Well, ordinarily, you have to write off the value of your building slowly, so you don't get the tax benefit of the building for a very long time. In the case of early childcare centers, it's going to be 39 years. So what we do with accelerated depreciation and cost segregation is identify the value of things that wear out sooner. Once you know that value, you can deduct it or write it off sooner. And so that allows people who own real estate to deduct much larger amounts early on in ownership. And this is where we get into the benefits. So why would you want to do this? The simple reason is this reduces your taxable income. I like to joke, anybody cannot pay taxes. We help people not owe taxes. Excuse me. So you do that by reducing your tax burden. I mean, we all, I think, probably understand the more write-offs and deductions you have, the less you owe. Usually, the trade-off is you don't get a deduction for nothing. You have to spend some money. So if you spend $1, you don't get $1 back. You get a certain amount of that back, whatever your tax rate is. Well, when you buy real estate, you're not getting the deduction for a very long time. And so we help people get that deduction earlier on. And as the bullet points show you here, that's going to help you reinvest in your business. So that could be adding locations if that's part of your goal. That could be expanding the property, the footprint, so you could have more capacity. It could just be the regular improvements and maintenance that are part of doing business. We all like understand. There's the average fee for your area, right? What's appropriate, what's acceptable, and that's based on a number of factors, including the facility. So if you're able to upgrade and improve your facility, maybe you could improve the rates that you charge people for coming there, or maybe this is going to allow you to add benefits or hire more people or whatever that looks like in the short term. So the name of the game here is the time value of money, and we'll get to that in a second, the bullets. But uh, if you could get tax savings now versus in 30 years, it's more valuable to you today because of things like inflation and your ability to reinvest that money. If you are going to spend your money on taxes, you never get that money back, right? You're going to send that check away and it's gone forever. Whereas if you are able to defer those taxes until much later, right? You just kick that can down the road. Well, then you have that money now. You can reinvest it in the business, and that allows the business to make more money, allows you to reinvest it and get a return. That's just mathematically simply a better strategy. So the ideal time, though certainly not the only time to do this, is when you're preparing to purchase or build a building. And that's just because you can use it in your financial calculations. So when possible, you want to, I mean, I think you've probably all done this, right? You look at real estate, you try to get an idea for what's the population like? Could they support a school? Are there enough young children there? What's my total addressable market here? So another thing you could look at is what is going to be the tax burden? Well, doing a cost segregation prior to purchasing a building allows you to model what your taxes are going to be in the early years of ownership because you know what your additional deductions are going to be. So you know really what, not just what your income is going to be, but what your tax-free income is going to be. So, especially in the early years of a business, I like to say, those are the riskier ones. This frees up capital for when you really need it so that you can stabilize. And whether it's your plan to buy and hold these businesses for long term or to stabilize and sell them, this is a strategy that's going to allow you to get more capital up front early to invest in the business and work towards whatever your exit strategy is. And again, the big idea here is if I could give you $1 every year for 39 years or a bunch of that money up front, most people would say, yeah, give me the money now because I can do something much more meaningful with it now than just wait to get it. So let's take a look at why this works so well for early learning centers. So what drives the value of a cost segregation is how much of the property is in components that wear out more quickly, right? Tom talked about the buckets. So there's the 5-year bucket, the 7, and the 15. So the more value that's in those buckets, the more you get up front. And early learning centers just happen to have a lot of value in those components because of the way they're built. So you can see here, you can probably think of the way your centers are set up. You've got, you probably don't have a lot of tile other than in bathrooms and eating areas because kids don't want to play on tile. They don't want to lay on it. It's hard. If they fall, they get hurt. Well, it turns out that that's actually beneficial for you. So things like carpeting and vinyl flooring are actually better for accelerated depreciation. And then the furniture and the fixtures and any equipment that going to get. And then you just have this repeated across multiple rooms very often. And then a big component is all of the things outside of the property. So in addition to what's inside the building, you've got just look at the facade on these, all of the signage, all of the parking. You might have playground equipment. You're gonna have fencing. You're gonna have landscaping. You might have lighting. The next two pictures really show this, and you can see just if you just kind of imagine, if you've built your building, you know the value that goes into the concrete, right? And the flow of parking and all of that. That's hundreds of thousands of dollars that ordinarily people would have to wait years to get. But in the example Tom used, you could get $1 million deduction in the first year. So to just to put it simply, if you built this school today, or if you bought this school today, you would have $1 million deduction that you could use on your taxes for 2025, or rather 2025. So what does that mean? That means unless you have more than $1 million worth of income, you will not owe taxes. And what happens if you have extra depreciation? You carry that forward into future years until you use it all up. So it doesn't expire. So we work with clients who legitimately do not owe taxes for multiple years because they're able to identify such a large amount of depreciation that it negates their taxable income for multiple years running. And the next picture just kind of shows some additional. I mean, if you're responsible for any kind of changes to the roadway, right, a long driveway, a curb, all of that, that's potentially eligible for cost segregation as well. So again, to kind of recap, the name of the game here is how can we identify the value of what is going to wear out quickly? And that's what the IRS lets you accelerate. And the one big beautiful bill just makes that even faster. So, we've thrown around some years and categories here, right? What's a 15-year asset? What's a 5-year asset? That's probably less important than knowing um, bonus depreciation, which was introduced with the one big beautiful bill or reintroduced, allows you to completely depreciate the 5-year, the 7 and the 15-year buckets right away. So, there might be $1 million in the 15-year components, like the driveway and the parking, but because of bonus depreciation, you can deduct all of that in the first year. If you think about the background of the president, he worked in real estate, so he understands the value of using real estate and depreciation to change his tax scenario. And that's you can see why that's such a big part of the tax strategy. And so now that's available for really anybody who owns any type of real estate that generates income. And I'll turn it back over to you, Tom.
Okay, great. So one of the things that Dan said, and it's a question that we get a lot, is that is it too late to claim bonus? And we talked about the years there. And the reality is, even if you've never claimed bonus, you may be able to claim it now. And Dan talked about the years when it was first rolled out under the Tax Cut and Jobs Act. 100% bonus was set to go from September 27th, 2017 to the end of 2022 at 100%. And then the way the tax law was written, it was going to drop 20% a year until it eventually went away. The one big beautiful bill came along in 2025 and changed that. So anything in the first few weeks in January, still we're at the 40%, which is that phased out number that happened to be in 2025. But after January 19th, 100% bonus is back. So if this is for a new new constructed building, or a purchased building after January 1st, or sorry, after January 20th, 100% bonus is eligible. And so the question is, well, I didn't know about this until recently. How can I benefit from it? Well, it's when a building is put in service, not when it's studied, that determines the bonus rate. So in case, let's say someone bought a building in 2020, they just found out about cost segregation now and they want to take advantage of it. We can do the study now. And even though it's, say, 2025, the fact that they bought it in 2020 means 100% bonus applies. And what happens then is that you take the difference between what you should have taken in depreciation and what you've already recorded since you've owned the property. That difference was what gets recorded, and that's the definition of a look back study. We're going to unlock those bonus depreciation dollars that you should have claimed, record it in the current tax year, and the IRS will let you do that without amending previous year's returns. Capture you're going to capture the missed depreciation currently. So you're being caught up to what you should have taken before. So you're not missing out on anything, and you're not having to go back and amend previous year's returns because nobody wants to do that, right? So let's give you an example of a look back study. This was something I had done. This was on a car wash. I don't know if you're familiar with Tommy's Express. I think it's kind of a more uh, mid America type of brand, but they're moving down into Houston. This one was actually built in 2019, and the CPA contacted me in 2023, and we did the study. They had a 39-year building value of a little bit over $2.8 million, and the booked depreciation in that line was 192,000. And they did classify the equipment correctly, but they put everything in the building in 39 years. So we actually did a study and broke out and identified almost $1.3 million because they were eligible for 100% bonus that they could have or they should have recorded. And so that was the differential piece between what they had recorded and what they could have. And so the 1.2 million was what was recorded in the current tax year, right? So remember, this was something that was built back in 2019, and we're doing the study in 2023. So that's a nice improvement in the current tax year without having to go back and amend previous. So I know this is a little bit hard to read, but I just kind of wanted to show you what we're looking for when we look at a depreciation schedule for an existing building. So the box in green here, that's the equipment, which is recorded as a 7-year asset, which is correct. What we're saying is that this 39-year asset of the 2.8 million is something that we can work on, and that's what we did the cost seg study on and broke it out into its component pieces where it was eligible for 100% bonus. So you can see right here the book depreciation of 192,000 versus what we really can and should book of almost 1.3 is a huge benefit. So this all sounds great, and people will probably think, how do we get started? It's really easy. We start with an estimate, and we need a few things to be able to produce that estimate. Number one is the purchase or construction price, the month and year the actual asset was placed in service, and then the renovations after purchase. So if you've owned it for several years and you've made some other capital improvements, we need to know about that so we can include that in our estimate. And then an address and a brief description of where this building actually exists. With these elements, we can come up with an estimate and give that back to you in usually about 2 business days. So if you don't want to remember these 4 elements here, I've actually got a QR code that will take you to a landing page where you can actually submit this information to me, and we'll get started on an estimate for you. So let's talk a little bit about the process for CSSI. How does this work? Like we said before, we're going to do a preliminary estimate where we gather some basic info we just talked about, and we're going to estimate the range of the potential savings, and we'll give you a quote on the study fee. Then if that's something that you talk to your CPA and decide this is something you want to proceed with, we ask you to sign an engagement letter, and then pay the deposit, which is going to be 50% of the total fee. And then we'll start collecting the required details from you because that's what we need to actually do the full study. Once we've gotten past that point, the study is going to progress until completion, and your part, or as the building owner or the tax professional, is really over. Unless we have questions on some of the information we've gotten, you can kind of just sit back and wait for the great news to come. And the study will be completed in a couple weeks, 2 to 4 weeks generally. The documentation is delivered to you and your CPA, and the balance of the study fee is charged, and then you can enjoy the benefits of that huge tax savings. So I know this has been a lot, and we've kind of gone through a lot of information. And what I do, I think I see a couple things in the chat, but I want to open it up to questions. If somebody has any questions, Jorge has one. So my client owns a building and runs a Montessori school out of it. Would they qualify for this? Absolutely. If they own the building, even if they don't run the school, they're the landlord and they're the owner of the building. So we can definitely do that. And I see that Daniel's actually answered that one. Um, okay, I'm looking at the chat. If there's any other questions, you can unmute yourself and then just ask it out. The second QR code is the one that people can use to actually submit the information to me that we need to run an estimate. I don't know if you got any questions. You're the only one I can see on here other than Daniel for some reason.
You already answered my question. it had to do with the carry forward of depreciation.
Yeah, absolutely. I mean, that's the one thing that people say, well, and the interesting thing is depreciation is one of the few things that can create or increase a net operating loss. So even if someone, you know, are kind of at a loss already, this could increase it. And like Dan said, any increased loss will just carry over to the next tax year.
Okay.
Tom, there's a question from Bhavana in the chat, which I think is actually really helpful.
Built in 2013 and serviced in 2013. Oh, you purchased it in 21. Yeah, that's a great question. Yes, the depreciation clock starts over with the new owner, right? So if you purchased it in 21, we're going to look at your purchase price and that's your depreciation baseline. So definitely, we can definitely look at that.
Yeah, it's funny, when oftentimes people think of depreciation, they think of cars, right? You buy a car, you buy it, you drive it off the lot, and it immediately loses value. That's a different meaning of the word, right? That's kind of resale value and depreciation. Um, this is referring to just an accounting term, right? It's simply how do you deduct or deduct it and write off the value of what you buy. And so depreciation starts over when you spend money. And that doesn't matter if the building is brand new or it's 100 years old. You still get to depreciate it over 39 years in the case of an early learning center.
Absolutely. So if anybody else has any questions, that's all we've got as far as the session today. We're not here to make you experts on this. We're just wanting to make you aware of what's available, and think this is something that actually we think people can actually benefit from because a lot of people don't know about it, right? Or they think they know a little bit and they're afraid to pursue it. So this is definitely something that if you own commercial real estate, you need to pursue. We'll definitely tell you whether it's worth it. That's the last thing we want to do is charge somebody it's like $3,000 and they're saving 4,000. That's not a big benefit. We want to make sure that you're getting a good return on it. So we'll tell you whether this is something that really may not work for you or not. But that's something it's a huge benefit, and you owe it to yourself if you own commercial real estate to pursue it at least to find out. Okay. Well, if nobody else has any questions, we'll go ahead and end this session because we didn't want to just stay on here forever. We wanted to get you the information, and this has been recorded. So if someone could benefit from this, reach out to me, let me know, and then actually we can pass it on, pass the recording on, or just set up a one-to-one Zoom with someone if they have a specific question. But I thank everyone for your attention and for attending the session.
Thank you.
Thank
Okay.
you, Iota. Thank you, Bhavan. Thank you, Rod. Thank you, Jorge. Thank you, Shannon.
Thank you. Appreciate it.
Great. Thank you.
Bye-bye.